It is the most frustrating paradox in algorithmic trading. You engineer a sophisticated predictive model. The backtest is flawless. The paper trading account generates consistent alpha. But the moment you deploy the exact same code into live market liquidity, the strategy slowly bleeds capital. The logic isn't wrong. The market regime hasn't shifted. What you are experiencing is the execution gap, the brutal reality of latency, slippage, and microstructure friction that destroys theoretical alpha. Algorithmic trading strategies often look flawless in simulation. The model, crafted in Python and refined with TensorFlow or Pandas, finds patterns that hold up in every backtest. Yet, when these strategies go live, the expected edge fades. The culprit is not the model's logic, but the chasm between generating a trading signal and actually filling an order in the market, a phenomenon known as the execution gap. This gap is defined by the interval between a model's signal and the moment the order is matched. Within this sliver of time, three forces work against the trader: latency, slippage, and market microstructure friction. Latency is the round-trip delay from signal to broker and back, often 200 to 400 milliseconds for a Python script using a retail broker's REST API. Each millisecond is an opportunity for faster traders to act first. Slippage is the price movement that occurs while an order is in transit, and by the time the broker processes it, the price is often shifted, usually to the trader's disadvantage. Microstructure friction comes from the order book itself. Large orders trigger institutional algorithms that consume the best liquidity and widen the spread, leaving slower orders to fill at worse prices or not at all. The loss unfolds along the signal to fill timeline. At T0, a model signals to buy the euro-dollar pair at 1.2000. The Python process serializes the order and sends it via HTTPS. Network latency to the broker's gateway takes 150 milliseconds. Broker validation and risk checks add another 80 milliseconds. By the time the order reaches the market, the best ask has widened and the original depth has vanished. The fill comes at 1.2004, not 1.2000. 4 pips are lost and the edge disappears. For Alex, an independent quant, the numbers tell the story. His backtested alpha of 15 basis points per month shrank to 2 or 3 in live trading. Fill rates dropped from 98% in simulation to 85% in production. Average slippage jumped from 1 pip to 12 pips. The problem was not the model, but a 250 millisecond lag in the microseconds where faster players claimed the edge. The execution gap is structural, rooted in the architecture of retail trading stacks. The model's signal is fast, but the execution lags. Every millisecond lost hands alpha to someone else. Python's dominance in quantitative research is undisputed. TensorFlow, PyTorch, and Pandas have turned it into the backbone of every serious data-driven trading desk. But when the research leaves the notebook and enters the wild, Python's interpreted nature becomes a liability. Every line of code, every network call, every order serialization must pass through the global interpreter lock, adding invisible but deadly friction. In live trading, this friction is measured in milliseconds, 200 to 400 milliseconds on average for a Python script pushing orders through a retail broker's REST API. That delay is not just a technical inconvenience, it is an open invitation for faster market participants to exploit the gap. While a Python process waits for an HTTPS round trip, high-frequency trading algorithms are already scanning the order book for signs of imbalance. They detect the footprint of a pending order, step in to consume the best available liquidity, and widen the spread before the original order even arrives. By the time the Python-driven trade hits the matching engine, the price has moved. The fill comes at a worse level, sometimes by several pips or ticks, and the strategy's theoretical edge evaporates. This is not a rare event. In fast-moving foreign exchange or equities, empirical studies show that a 250 millisecond delay can erode as much as 12 to 38 basis points of expected alpha per trade. For high-frequency strategies, that is the difference between a profitable system and a losing one. The technical bottleneck is structural. The REST protocol, designed for reliability and simplicity, was never meant for sub-second execution. Each request is wrapped in layers of HTTP headers, TLS handshakes, and broker-side validation, all stacking up to create a latency floor that no amount of Python optimization can break. Even with async frameworks or Python-compiled hot loops, the round trip remains fundamentally slow compared to compiled execution engines running on the same machine as the broker's gateway. Meanwhile, institutional firms sidestep these pitfalls entirely. They separate the brain, the Python model that generates signals, from the hands, a compiled execution layer in MQL5 or C++. Signals are streamed over ultra-fast protocols like ZeroMQ or WebSockets. The compiled layer, running on a low-latency VPS or co-located server, handles real-time order placement, dynamic slippage checks, and even autonomous throttling if the spread widens beyond the model's edge. Orders are injected into the market in as little as 4 to 8 milliseconds, preserving the alpha that would otherwise be lost to faster players. For the independent quant, this is not just a technical detail. It is the dividing line between backtest fantasy and live market survival. The predictive power of your model is meaningless if the infrastructure cannot deliver it to the market before the opportunity is gone. True quantitative edge demands an execution architecture that matches the speed and ruthlessness of the competition. Subscribe for more deep dives into the technology that separates winning systems from wasted potential. A robust trading system separates intelligence from action. The predictive model, the brain, remains in Python, leveraging TensorFlow, PyTorch, and Pandas for research and signal generation. But when it comes time to execute, the hands must be fast, decisive, and immune to the bottlenecks of interpreted code. That is where the compiled execution layer steps in. Institutional architecture routes signals from Python to a native layer, MQL5 or C++, using ultra-fast protocols like ZeroMQ or WebSockets. Unlike REST, which stacks up 200 to 400 milliseconds of unavoidable delay, these direct sockets deliver signals in under a millisecond. The execution engine, running on a co-located VPS, receives the trade command and injects the order into the broker's gateway in as little as 4 to 8 milliseconds. This is not a theoretical claim. Industry benchmarks and public case studies confirm single-digit millisecond order placement using this design. The compiled layer does not just act quickly, it acts intelligently. It monitors real-time spreads and liquidity, applying dynamic slippage guardrails. If the spread widens beyond the model's expected edge, the execution engine can throttle or cancel the order entirely, preventing capital from being wasted in a liquidity vacuum. This level of control is impossible in a pure Python pipeline, where every order must wait for the global interpreter lock and the round trip of HTTP validation. ZeroMQ and WebSocket transports make this architecture practical for independent quants. Both protocols support asynchronous, high-throughput messaging and can be secured with TLS or VPN tunnels for compliance. The result is a system where the Python brain can focus on generating edge while the compiled hands deliver that edge to the market before it disappears. In this blueprint, speed is not just a feature, it is the foundation. Without a single-digit millisecond execution path, even the sharpest model is powerless against faster market participants. Subscribe for more breakdowns of the infrastructure that turns research into real-world returns. Numbers cut through the debate. When Alex migrated from a Python REST pipeline to a ZeroMQ bridged MQL5 execution layer, the impact was immediate and measurable. His logs, verified by broker side trade confirmations, recorded a drop in the 95th percentile signal to acknowledgement latency from 238 milliseconds to just 7 milliseconds. Fill rates, which had languished at 86% under the old REST setup, climbed to 95%. Realized alpha, once stuck at 3 basis points, rebounded to 12 basis points. The Sharpe ratio, a direct reflection of risk-adjusted performance, more than doubled, from 0.9 to 2.3, over the same strategy and market conditions. An A versus B experiment run across 2 brokers over 30 days confirmed these results. Variant A, the control, executed trades via Python REST and suffered average slippage of 12 basis points per fill. Variant B, the treatment, used the Python 2 MQL5 bridge and cut slippage to 3 basis points. The adverse selection rate, the fraction of trades reversed within a second, fell from 4.2% to 1.1%. CPU utilization told its own story, with Python's GIL bound process spiking to 85% during order bursts, while the compiled MQL5 executor stayed below 30%, handling concurrency with ease. A robust diagnostic dashboard tracked every critical metric: realized slippage, time to fill percentiles, fill rate, and latency distribution. Each trade log captured signal timestamp, intended price, actual fill, and spread at execution. Heat maps and scatter plots traced the direct relationship between latency and slippage, often with a correlation above 0.6 for high-frequency strategies. The evidence is not anecdotal. It is reproducible, broker-stamped, and statistically validated. For latency-sensitive trading, the bridge does not just close the execution gap, it reclaims the alpha that slow infrastructure leaves on the table. Subscribe for more forensic breakdowns of trading system performance. Every millisecond counts. Python's TensorFlow, PyTorch, and Pandas empower your models, but a rest delay of from 200 to 400 milliseconds hands your alpha to faster, institutional algorithms. Unless your infrastructure bridges the divide between the brain and the hands, prediction becomes profit for someone else. The edge is execution. Subscribe for more on building real trading systems.